Welcome to Silver Eye Academy. Today, we are going to introduce bonds. What are bonds? Bonds are financial instruments used by governments, corporations, and other entities to raise capital from investors. At its core, a bond is a debt security. When investors buy bonds, they are essentially lending money to the bond issuer. The bond issuer, in turn, promises to repay the principal amount of the bond at a specified maturity date. In addition to the repayment of the principal, the issuer also pays periodic interest payments, known as the coupon rate, to the investor. Bonds have a specific maturity date, which can range from a few months to several decades. It is important to note that the value of a bond can fluctuate based on various factors, such as changes in interest rates, creditworthiness of the issuer, and overall market conditions. One of the reasons why bonds are considered a relatively conservative investment is because they provide a fixed income stream in the form of coupon payments and the return of the principal amount upon maturity. Bonds are commonly used by individuals, institutions, and governments alike as a means of generating income and managing risk in their investment portfolios. Why invest in bonds? Investing in bonds can provide several potential benefits. 1. Bonds offer a fixed income stream in the form of periodic interest payments, which can be attractive to investors looking for a reliable source of income. 2. Bonds are generally considered a lower-risk investment compared to stocks or other riskier investments, providing a measure of capital preservation for investors. 3. Bonds can be an effective way to diversify an investment portfolio, potentially reducing overall portfolio risk. 4. Bonds can provide stable returns, especially when held until maturity, which can help investors achieve their financial goals over the long term. 5. Bonds can also provide a hedge against inflation, as many bonds offer inflation-protected interest payments. Following are the key parameters observed in a bond. Indicative price is an estimated or approximate price at which the bond might be traded in the market, based on current market conditions and available information about the bond's features, such as its coupon rate, maturity, and credit rating. Yield to maturity is the annualized rate of return an investor can expect to earn if they purchase the bond today and hold it until maturity, assuming the bond issuer does not default on its payments. Yield to call is the total return anticipated on a callable bond if the bond is called by the issuer before it matures. A callable bond is a bond that the issuer has the option to call back or redeem before the bond's scheduled maturity date. Similar to yield to maturity, yield to call takes into account the current market price of the bond, the face value of the bond, the coupon rate, and the time remaining until the bond's call date. Settlement amount refers to the total amount of cash that is exchanged between the buyer and seller of the bond at the time of settlement, which is typically 1 or 2 days after the trade date. The settlement amount includes the price of the bond, which is the agreed-upon purchase price between the buyer and seller, as well as any accrued interest or other fees associated with the transaction. Accrued interest is the amount of interest that has accumulated on a bond since the last interest payment was made. When an investor buys a bond between interest payment dates, the investor must pay the seller the accrued interest for the period that the seller held the bond. This is because the seller is entitled to the interest payment for that period. For example, let's say a bond has a coupon rate of 5% and pays interest every 6 months. If the last interest payment was made 3 months ago, the accrued interest would be 5% divided by 2, multiplied by 3 months, or 0.625% of the bond's face value. When the investor receives the next interest payment, they will only receive the interest for the period of time they actually held the bond, since they have already paid the accrued interest to the seller. If you are an accredited investor, you may have the opportunity to be eligible to invest with one of Silver Eye's strategic partners. Please visit our website for more information at www.silvereye.com. Under the Monetary Authority of Singapore regulations in Singapore, an individual is considered an accredited investor if their net personal assets exceed 2 million Singapore dollars, or their income in the preceding 12 months was at least 300,000 Singapore dollars. It is also important to carefully evaluate the risk and potential returns of such investments and seek the advice of a licensed financial advisor before making any investment decisions. Thanks for watching.